President Trump just announced large tariffs against Canada, Mexico, and China. Stock market media and so-called experts are in freak-out mode. But I'm staying true to my investing strategy and still buying U.S. dividend growth stocks. Prior to market open, futures were down 2% on the S&P 500 and 3% on the NASDAQ. However, that sell-off was short-lived and the dip ended up being much lighter as we traded Monday. My personal dividend growth portfolio is down far less at around 0.15%. So despite the large media reaction, you couldn't even really tell from my portfolio. That said, across the broader market and even on my personal watch list, there were many stocks down big from the tariff news. Today, I'll give my thoughts on the Trump tariffs and how they will impact my investing strategy. That will include a deep look into the investing mindset. I'll also take a trip back in time to 2018 when the first Trump trade war was in full effect. At that time, legendary investor Warren Buffett had some great insights that still apply today. On top of that, I'll share wisdom from another great investor, Peter Lynch. He gave great advice on how we individual investors should think about news stories and market fears like these tariffs today. Finally, I'll give a full update on my personal dividend growth stock portfolio and share the 2 stocks I just bought. With that said, let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using the best stock research tool for dividend investors, which is available at dividenddata.com. I'd also like to share that for those of you who want to track your portfolio on dividenddata.com the same way I do, there's going to be a new brokerage added for support later this week. I'm going to release an update that will allow users to link their Fidelity brokerage with Dividend Data, so stay tuned for an announcement on that. Let's dive into my portfolio and the news of the day. My current portfolio value is $207,800 with a little over $125,000 invested. That puts my total return at 65.62%. But we have had a lot of volatility in the market lately with the China DeepSeek news and the AI tech sell-off that followed. And now the Trump tariffs causing another Monday sell-off. But my dividend portfolio now is actually at its highest value ever. And the month of January was my largest month of dividend income ever. I made $626 in dividends. I actually used the market sell-off around these events to add to my dividend stock portfolio. I didn't buy that much. It was around $2,000 across 2 different stocks. And if you stick around to the end of the video, I'll share which stocks that is and why I bought. But first, let's get to the tariff news. I'll start with what we actually know right now. So on February 1st, Trump announced a 25% tariff on Canada and Mexico. That applied to most imports with very little exceptions. Another 10% tariff was announced on China. And over the weekend, Wall Street analysts were hard at work to try and realize what the economic impacts of these tariffs would be. This could impact sectors like agriculture, automotive, some electronics, energy, and liquor. And I'm not necessarily going to break down the politics or my thoughts on the economic impacts of these tariffs in this video, but I'll try and address it from a big picture lens. First, I'll start on the local level of my investments. I'm mostly focused in US tech and energy, and as I'm looking at the businesses here, there are very few that would be negatively impacted by these tariffs. If anything, you could argue that it maybe helps some from a competitive standpoint. And again, if we go back to the big picture of the man putting on these tariffs and then negotiating them, if you've followed President Trump at all, you know that he likes to use tariffs for negotiation purposes. And he even outlined in his post many non-economic reasons for why the tariffs were introduced. And in fact, he already met with the president of Mexico earlier today, and they have agreed to many concessions, and the tariffs are now being postponed at least a month. There are expected to be continued negotiations beyond that. Trump is also expected to meet with the leader of Canada in a few hours after I'm recording this video. So it's possible there could be a similar deal there. But yes, if these tariffs do go into place, there is a real economic impact, most notably the incentive structure of where you're importing many products from. So if they stay in place, it's possible over the long term that supply chains may shift. And in the meantime, the US government would raise revenue through the tariff. So this can impact the business practices of some individual companies. But again, as individual investors, especially in US stocks, we need to take a step back and look at the big picture. And there's no one better to do that with than one of the best investors of all time, Warren Buffett. It's also important to remember that a lot of this exact same conversation we're having today has happened in the past. And it wasn't even that long ago. You just have to go back to Trump's first term. Back in 2018, tariffs and the Chinese trade war was a big topic of conversation, and it was scaring markets. And Warren Buffett gave some great insights that are still relevant today. So I'm going to play that clip right now.
The China tariffs potentially mean for business and what they mean for Berkshire, but you're looking at the markets down almost 500 points this morning. And for people who are just waking up and just kind of trying to figure out what this means for them, for their portfolios, for their businesses today, I'm sure they've got some questions. What can you tell them? What do you say when you look at the markets, I guess, down 460 points right now for the Dow?
If you have a decent business, I mean, you buy into a business. You don't buy a stock that wiggles around, and people understand that. But then they behave as if it's bad news when the price goes down. If you had a half interest in a wonderful business, and the person that owned the other half came in and they were depressed by these headlines today, and they said, "I'll sell to you my share of the business a lot cheaper than yesterday because I think this whole thing is going to just end the world." You just say, "Here, I wish you weren't so depressed, but but if you're selling it to me cheaper, the business is going to be here 5 years from now and 10 years from now." And all headlines, you don't know what the world's going to look like in 3 years or 5 years or 10 years. What you do know is that the United States is going to grow over time and that businesses are going to generally do well. And if you own decent businesses, you'll make money.
It could be an impact that's fairly
well, you have
large
to run
in the short to medium term.
Our own subsidiaries, obviously, where they thought that tariffs could be increased, they've loaded up more on inventory. I mean, you make business decisions, but you don't make a decision about whether to buy or sell the business if you've got a good business. And you've got to, if you're going to own a business for 10 years, you're going to see a lot of terrible headlines. I bought into my first business in 1942, and they didn't notice that I did. But just imagine all those headlines at that time, and the world, the Philippines were falling. I mean, we were losing the war, and but the United States is going. Your kids are going to live better than you did, and your grandchildren are going to live better than they do. And generally speaking, productive assets are going to be worth more in this country. And if you own a diversified group of productive assets, you'll do fine as long as you don't read the papers.
This Chinese trade war was a huge deal at the time, and there was tariffs put in place on Chinese goods, and those remained in place and are still in place today. And what happened? The stock market has continued to grow massively since then. Stock prices are up, earnings are up, dividends are up. And the reason why is there are many individual businesses in the United States that continued to increase their productivity and earnings. For example, Microsoft has tripled their earnings per share since 2018. So if we go back in time to 2018 and look at their stock price, there was big sell-offs in that year, some of which were related to trade. And if my memory serves correct, interest rates were also a big topic of conversation in fall 2018. But when we zoom back out, did that matter? No, because when you're investing in a business that's tripling their earnings in that time, it's not really relevant. And Microsoft's just one example. There are hundreds of different companies you can invest in the S&P 500. And over the long term, the productivity of those businesses is going to increase. There are always going to be these news stories that try to scare you out of owning productive assets. This week it was Trump's tariffs. Last week it was China DeepSeek. But you have to keep your eye on the long-term picture. There is always some macroeconomic reason not to buy stocks. But in reality, the only mistake you can make is to never buy. Now I'm going to share this great Peter Lynch clip where he talks about this investing mindset. There is always some news story to worry about. And this is especially relevant today because there is nobody that makes news like President Trump. He has reporters in the media working overtime since he's been back in office. And this is going to be a constant theme over the next 4 years. And it will be a theme throughout your entire life. So let's hear what Peter Lynch had to say about this.
There's always something to worry about. This is the difference. This is what happens in the stock market. Because, see, everybody's got the brain power to do well in the stock market. The question is whether you have the stomach for it. That's the key organ in the body. There's always something to worry about. So people weren't buying stocks in the 50s because they thought that another Great Depression is going to happen. In addition, People were very scared about nuclear warheads and nuclear war in the 50s. People were building fallout shelters, stocking canned goods. There's something about going to Vermont, building a fallout shelter, putting canned goods in it, that you don't buy Minnesota Mining or you don't buy Eastman Kodak. I mean, the syllogism just doesn't work out, that you're buying lots of water, buying a shotgun, buying frozen food that will stay in the freezer with your own generator, and you're looking at growth stocks. Doesn't seem to work out that way, Every one of these little countries has enough warheads to blow the world up 88 times. Like, who's built a fallout shelter lately, We stopped worrying about it. I mean, there's always something to worry about. In the 50s, it was depression and nuclear war. The 50s was the best decade this century for the stock market, except for the 80s. Only slightly better. The 80s are only slightly better. People didn't expect a lot. We had an okay, it wasn't a great decade. They just didn't expect much. We made it through. And the stock market was terrific. Do you remember when oil went from 4 to 40? Remember that period? Oil went from 4 to 40, and the experts said it was going to go to 100, and all the countries of the world were going to go bankrupt. And then the big banks are going to go bankrupt, and we're going to have a Great Depression, and the stock market's going down, and you're going to wind up selling pencils and apples. Well, I remember when oil went from 4 to 40, and the experts said it was going to go to 100. Within 2 years, oil was at 14. The experts, now much higher paid at this point, are saying it's going to go to 4 and we have a depression. And people believed it again. I remember when the money supply was growing too fast, and they said we're going to have a depression. That was growing too slow, we're going to have a depression. Then the Mideast was going in the world, remember that one? The Mideast was going in the world, then we're going to buy our bonds, and the market crashing, we're going to have a depression. Then Japan was going in the world, remember that one? Japan was going to have all the assets, and they weren't going to buy our bonds, and we're going to have a depression. Within 3 years, the Nikkei Dow had gone from 40,000 to 16,000. The banking system was in trouble, and people said Japan was going to collapse, and we're going to have a depression. I mean, people, on their prayer list, at the end of the day, they eliminate crippled children and Mother Teresa. They're praying for Japan. I mean, it's a country with a 15% savings rate. It's some bizarre, Commercial real estate, global warming, And I think the older you get, the more nervous you get about these things. I think it's very valuable. I think younger people are better investors is they're not worried. They haven't heard about all these crises. And they're with children. I think if you don't have any kids, you got to rent some kids for the weekend. Get a 7-year-old and ask him if he knows about the money supply, how fast it's growing. Ask him if he knows about the shape of the yield curve is the wrong shape of the yield curve. Or that we're 48.3 months into the economic recovery and the average recovery lasts 52.3 months. Ask an 8-year-old if they know about that. 8-year-olds have a very high expectation about the next 20 years. That's what you need to do. The more you get away from 8-year-olds, the more you get away from 11-year-olds, the more you start reading these crazy things you read over the weekend. But I'll guarantee you, the market will be a lot higher in 15 years. It'll be a lot higher in 25 years. What it's going to do in the next 1 or 2 years, I don't have any idea. So I don't worry about that. I know we've had 96 years a century, and the market's fallen 53 times. We've had 53 declines of 10% or more. So 53 declines in 96 years. Once every 2 years, we have a 10% decline. Of the 53 declines, 15 have been 25% more. So 15 in 96 years, about once every 6 years, the market falls 25% or more. That's what we call a bear market, you know that. And it's going to happen. I don't care when it's going to happen. I would love to know. Obviously, it would be very useful to know when it's going to happen. It doesn't make a difference to me. Corporate profits will be a lot higher 8 years from now, a lot higher 16 years from now, a lot higher 30 years from now. That's what I deal with.
There is always going to be something to worry about. But when it comes to investing in individual stocks, the only thing that matters is the productivity of the individual businesses you're investing in. Are their earnings growing? Do you expect them to continue growing in the future? How sure are you about that? And then what price you are willing to pay for that future earnings growth. That's the whole game. And the farther you get away from the reality of these individual businesses you're investing in, the more lost you'll get. These are all businesses generating earnings, free cash flow, revenue, and to a varying degree, they pay you out their profits as dividends. So no matter what happens in the broader economy, I'm going to be focused on finding high quality businesses that I think will grow in the future and continue to pay me a growing stream of dividend income. And I used this recent sell-off as a buying opportunity. I bought 2 shares of Microsoft, one at $418 and one at $411. And why did I buy? It's because the stock has been largely flat for a year, and I know that this is an extremely high quality growing business. They have a dominant market position, and their earnings are only expected to continue growing in the future. This is a company that pays a growing stream of dividend income, increasing it 10% a year. Microsoft is the second largest stock in my personal dividend growth stock portfolio. I have a 71% total return, but I haven't bought any really since fall 2022. So I took this sell-off as an opportunity to slowly start dollar cost averaging into buying more of the position. I would prefer if it sold down way more, but I'm fairly confident that Microsoft will continue growing double-digit earnings per share into the future. And a lot of that's going to come from their cloud business, which is growing fast. And specifically in that cloud business, their AI revenue is now at a $13 billion run rate, and that increased 175% year over year. Now, hey, this isn't a full Microsoft stock review video. Maybe I'll do another updated one on that in the future. But those are my general thoughts. I also used the sell-off as an opportunity to open a position in a stock I've been targeting for a while now. That is Texas Pacific Land Corporation, ticker symbol TPL. I bought one share at $1,255, and this is now the newest addition to my dividend growth portfolio. This stock trades at a pretty high valuation, but is a extremely high quality business that I think is set to grow well into the future. I'm not going to do a full stock analysis video right now, but you can go watch my top energy stocks video, and I did give a few minute breakdown on TPL stock. And what happened here is I used the 7% sell-off from the DeepSeek news to start my position in the company. I'm planning this to be a multi-decade position, and there will be various opportunities depending on how the oil market is to load up on the company in the future. I really just wanted to make sure I had it in my portfolio, so I had a very clear eye on it. So there you go. We had the crazy Trump tariff news, and my portfolio is now up on the day. And what am I doing? I'm keeping a long-term perspective and still buying high-quality dividend growth stocks for the future. If you enjoyed the video, please leave a like, comment, and subscribe to the channel. And if you want to use the stock research tool I was showing throughout the video, it's available at dividenddata.com. Link in the description and pinned comment of the video. With that said, I'll see you in the next one.